Hello everyone, I'm Jesse Arman, and today we're going to be talking about weighted average cost of capital, or WACC. Weighted average cost of capital is exactly that. It's the cost for a company to raise funds, and it's a combination of their cost of debt and their cost of equity. Now, a couple things to know about weighted average cost of capital. First of all, it changes. It's fluid. And the reason it changes and it's fluid is because some of the inputs to weighted average cost of capital change every day. In fact, they change every minute. Some of the inputs to weighted average cost of capital will be stock price, which of course changes every 5 minutes, and beta and treasury bill rates. So the good news about weighted average cost of capital is that companies don't have to calculate it on a regular basis. They just have to calculate it when they're looking to raise money. So, one other thing about weighted average cost of capital is this. It's a guideline. And generally, what companies use weighted average cost of capital for is that they should not pursue initiatives that pay less than their weighted average cost of capital. If you think about this, if it costs a company 5% to raise money, whether it's through debt or through equity, and the company anticipates using it for an initiative that only pays 4%, it doesn't make sense to pursue that initiative. So weighted average cost of capital is fluid, and the guideline is that it's to be used as a hurdle rate. If the company anticipates making more than the weighted average cost of capital, it should pursue that initiative. If, on the other hand, the initiative is expected to return less than the weighted average cost of capital, then the company should bypass it. Does that make sense? Okay, let's move away from the theory and into the actual details. To calculate weighted average cost of capital, we have to calculate the cost of debt and the cost of equity. So let's start with debt because it's easier. To calculate the cost of debt, you have to go into the company's 10K, the most recent 10K, and see what the company paid in its most recent debt issuance, long-term debt issuance. So I'm going to make these numbers up. Don't look for them anywhere. The math will work, but the numbers are made up. Let's say that in the most recent 10K for this company, it issued long-term bonds paying a coupon rate of 5.25%. 5.25%. You went into the 10K, you found that 6 months ago, the company issued $500 million worth of bonds at a coupon rate, a face rate of 5.25%. That is the before-tax cost of debt. To figure the after-tax cost of debt, you have to determine the tax rate. And that's pretty simple. You take a look at the income statement, and that income statement is also found in the 10K, or you can go to sites like Yahoo or NASDAQ or Morningstar and find the income statement there as well. So let's make some numbers up. Let's say that this company's income tax expense from the income statement is $455 million. And the earnings before tax were $1,209 million. Okay? Company made earnings before tax of $1,209 million and paid income tax of $455 million. You can find that right on the income statement. $455 million divided by $1,209 million equals 37.6%. You have a pot of coffee in the morning, you can do that calculation in your head as well. This is the tax rate, 37.6%. To get the after-tax cost of debt, all you do is you take the coupon rate of 5.25% and multiply it times 1 minus the tax rate. And that comes out to 3.28%. So, this is half of the equation. We're dealing with the cost of debt. We start with the most recent coupon rate of long-term debt, 5.25%, which I'm making up. Then you take a look at the income statement. Once again, wherever you found that income statement, whether it's the 10K or whether it's on one of the consumer sites, and we have determined income tax expense of $459 million divided by the earnings before tax, EBT, 37.6%. So all we have done is reduce the coupon rate of the debt by the tax rate, and we come out to an after-tax cost of debt of 3.28%. Why are we figuring after tax? Because interest on bonds is tax deductible. The cost of this debt to our company is not really 5.25%, it's 3.28%. Make sense? Okay, let's move over now to the cost of equity. Cost of equity is perhaps a little bit more interesting, and what we are going to use to determine the cost of equity is a concept called the capital asset pricing model. Now, what I want to tell you about the capital asset pricing model is this. Some of you may be familiar with it already. Some of you may never have heard about it. It's not that critical that you understand the capital asset pricing model for the purpose of determining cost of equity and the weighted average cost of capital, but I guarantee you will run into the capital asset pricing model in either an investment class or in another finance class, so you'll see it eventually. Now, there are three things that we have to know for the capital asset pricing model. One thing that we have to know is we have to know the beta. And beta is a measure of a stock's volatility. A beta of 1 is exactly as volatile as the market as proxied by the S&P 500. A beta of less than 1 means that the market is a little bit less volatile than the S&P 500, and a beta of more than 1 means that the stock is a little bit more volatile than the market in general. We also have to know the risk-free rate, which I'm making up, and the risk-free rate is proxied by the 1-year T-bill, a 1-year T-bill. You can find a 90-day T-bill and a 6-month T-bill. This is a 1-year T-bill. Now, I'm making this up, although this is not too far from the truth right now. Right now, T-bill rates and all interest rates are really, really low. And the third thing we need to know is we need to know the market premium, and I'll talk about that in a second. The way the capital asset pricing model works is you take the risk-free rate, which in this case is 0.13%, not 13%, 0.13%, and to that you add the beta times the market premium, and I'm going to use 7% as the market premium. And the reason for that is that over the last 100 years, the stock market, once again, as proxied by an index like the S&P 500, has returned approximately 7% more than the risk-free rate as measured by a 1-year T-bill. What's it going to do this year or next year? Nobody knows. I don't know, you don't know, the fundamental and technical analysts don't know what the market's going to do this year. But over the last 100 years, the market has outperformed the risk-free rate by about 7%. So let's take a look at this equation. It's the risk-free rate plus the beta times the market premium. If you haven't taken algebra in a long, long time, for me it was the Truman administration, this is the way it works. The last thing you want to do is take 0.13% and add to that 0.9 and then multiply the whole thing by 7%. No. Instead, you take the 0.9 times 7% first. That comes out to 6.3%. And then you add the risk-free rate of 0.13%. So this comes out to 6.43%. Now, one other thing you don't want to do is you don't want to confuse this 0.13% with 13%. It's not. That's 13 basis points. You call this 13%, you're going to come out to something entirely different. So this is the equation for the capital asset pricing model. A rational investor would expect a return of about 6.43% on average for this company. But more importantly, for the purposes of calculating weighted average cost of capital, we now have the after-tax cost of debt, and we also have the cost of equity. We don't adjust this for income tax because there's nothing tax deductible about dividends or stock issuance. So we've got our two components, and now we have to put them together in the weighted average cost of capital equation. Make sense? Okay, so we have two pieces of input. One thing that we have is we have the cost of debt, and the cost of debt is 3.28%. Once again, that's after-tax cost of debt, and the cost of equity is 6.43%. Now, those are our major inputs. Remember that this is a weighted average cost of capital. If this were simply an average cost of capital, all you'd have to do is add up those two numbers and divide by 2 and you have an average. But it's a weighted average, which means we have to determine how much debt this company has and what its market value of equity is. So where do you think you find how much debt this company has? You look at the balance sheet. The balance sheet, once again, you can look in the 10K or you can look on any one of the consumer sites like Yahoo Finance or Morningstar. Either place you're going to find it on the balance sheet. So for this company, what we're going to find is long-term debt, LT debt, and it's going to be $2,191,000,000. Where are you going to find that on the balance sheet? Under long-term liabilities or other liabilities. It is not going to be a current liability. Current meaning those debts that the company is going to pay within 1 year or less. This is going to be long-term debt. Now there's another part of long-term debt, and that is called the current portion of LT debt. And let's make up a number here. How about $629 million? Okay, $629 million. You're going to find that under the current liabilities section because this is the amount of the long-term debt that this company is going to have to pay this coming year. Now there's actually some short-term debt involved in this as well, but usually it doesn't amount to enough for us to worry about it. So to find out this company's long-term debt, you have to determine the long portion of it, in other words, the debt that's going to be paid in years subsequent to the coming year, and the current portion, which means the debt that's going to be paid this year that relates to this long-term debt. So what does this come out to? $2,820,000,000. Okay, that's the debt portion. Make sense? Okay, let's move on to equity. Now we're going to have a change in direction here. To determine the company's equity, you don't look at the balance sheet. Using the capital asset pricing model, you look at the market capitalization. Market capitalization, or market cap as it's called, is simply the number of shares outstanding, which means the number of shares that are in shareholders' hands, times the closing stock price. It's pretty simple. So if a company has 1 billion shares outstanding and the stock price is $30, the market cap is $30 billion. The really nice thing about this is you don't have to do a calculation. All you have to do is get onto Yahoo Finance or Morningstar or any one of those sites, and you will see market cap in the opening page. So for this company, let's say that the market cap is, and it's almost always much larger than the debt involved, $16,830,000,000. The total, therefore, boy, I hope I can do this, $19,650,000,000. This is the company's total capitalization. Let's put a $sign there. Once again, the total debt from the balance sheet, two parts of it, and this is the market cap. You should never have to calculate this. If you find yourself in a situation where you're having to calculate the market cap, chances are you're looking in the wrong place. Just open up to that entry page for your company and you will find the market cap in the top right-hand corner. So the question is, what percentage of this total capitalization of nearly $20 billion is comprised of the debt, and what percentage of this nearly $20 billion is comprised of the equity? Well, this is pretty simple. $2.8 billion divided by $19.65 billion, this comes out to exactly 14.35%. Once again, the way you do it, $2.8 billion divided by $19.65 billion comes out to 14.35. Try it. You'll see. Don't take my word. The market cap of the equity, 16.83 divided by 19.65, it's just the difference. It's 85.65%. I would suggest that you calculate it, 16 billion divided by 19 billion, find the number, And if these two numbers don't add up to 100%, guess what? You've made a mistake. So what we can say is that this company's market capitalization is 14.3, or excuse me, corporate capitalization is made up of 14.35% debt and 85.65% equity. So now we get to the good part. Now that we know what the capital structure looks like, the rest is pretty simple. The debt is going to be 14.35% times the cost of debt times 3.28%. And that comes out to 0.47%. Not 47%, 47 basis points, or a little bit less than half of 1%. The equity, on the other hand, is 85.65% times 6.43%, and that comes out to 5.51%. Do the calculations. You'll come out to the same. So the weighted cost of debt is 47 basis points, 0.47%. The weighted cost of equity, 5.51%. The WACC, drum roll please, weighted average cost of capital is 5.98%. So here's what this all means. This company has an initiative that it's considering. It anticipates that the initiative is going to pay back 6.5%. It takes a look at its weighted average cost of capital and says, you know, we raise money, it's going to cost us 5.98%. If we raise money through debt or equity, we're going to make 6.5% on this initiative, which means the initiative is going to add value to this company. On the other hand, let's say that they anticipated that initiative would only pay 5%. The weighted average cost of capital is nearly 6%. Why would they do that? Why would they raise money costing them 5.98% to get a return of 5%? The answer is they would not. This 5.89% is the hurdle rate for this hypothetical company. This is pretty simple. Okay, I know you followed this. I know you followed the calculations. I know you nodded your head along with this presentation. Here's what you need to do. Take your company, look at this video once or twice to make sure you know what you're doing. Calculate the WACC for your company. And if you have any problems, drop me a line. Thanks.